Hi everybody, welcome back. In this video we're going to start a new section of lectures on the money and banking system. So we're going to have a few lectures on the basics of the money and banking system. We'll talk about monetary policy, and then we'll talk about some financial crises as well. But this first chapter is just high level money and banking system. What is money? Functions of money. We'll talk a little bit about the Federal Reserve System, who's in charge of monetary policy, and some of the tools that they use to help the economy in times of recession. So let's go ahead and dive in here. So we're gonna start out by asking ourselves the question, what is money? And if we didn't have money, how would the economy work? And in the past, that's been sometimes somewhat the case. If we didn't have money and we reverted back, and actually, even in some parts of the world, even in parts of the U.S., there's bartering. So the trading of goods for other goods without that intermediate step of the money. The problem with bartering system is you have this thing called the double coincidence of wants. And the idea there is that this is a situation in which two people each want the same good or service that the other can provide. So, let's go ahead and write that down. I'll talk a little bit about it. So, a situation in which two people each want some good or service that the other can provide. Okay, and this is necessary in barter economies. So, to take a somewhat silly example, if I've got some chickens and I need some milk, well, not only do I have to find somebody who has milk, that's the first coincidence, but the second coincidence is that person who has milk also has to want chickens. And so there's that double coincidence of wants there, where if we had money, that money can kind of act as an intermediate step. So I can sell my chickens for dollars, and then I can use those dollars to pay a dairy farmer. So the dairy farmer doesn't have to want chickens. I can just pay him with cash, right? So that's coming to this idea of what money is. And so it's a stock of assets. We think of it as an asset generally, and we use it for transactions. There are three primary functions of money. So the first is a medium of exchange. And this is kind of the general idea of how we think about money. We use it to buy things or to sell things. And in exchange, we use money. Another function of money is a store of value. So if I have some assets and I want them to maintain value over time, one possibility for that is holding on to money. I could also hold on to a house. Houses are generally good stores of value. Money is also a pretty good store of value. As long as there's not super high inflation, then money is a good store of value. And then the final function of money here is that it is a unit of account. Basically, it's how we measure the value of things. It's how we price things. And so we can, if a banana costs $1 and an apple costs $2, we know that an apple is worth twice as much as a banana because of their prices. And so that's this idea, kind of, I mean, in a way, prices are related to the medium of exchange as well. But it's basically how we measure things' values. Okay, good. Oops. So let's carry on. So we have different types of money, and in the past, we've had all sorts of different types of commodity money. Nowadays, most developed nations use what's called fiat money. In fact, most nations in general. But commodity money used to be very popular. This is an item that is used as money, but also has value from its use as something other than money. So an item that is used as money, but also has value from its use as something other than money. Also has value from its use as something other than money. Okay, common example here would be gold, or other, let's put that, or other precious metals. So gold, silver, other types of metals have been used as money in the past, but gold has value for things other than money. I can use it for a ring or a necklace or other jewelry. I can use it to plate something really nice, or turn it into gold leaf and put gold leaf on things. So gold has value outside of its monetary value, but it can, and in the past has been used for money as well, typically based on weight. So I'd encourage you to maybe pause and think about a couple other different types of commodities that have been used for money in the past. And I'm going to add a few more here now. So a couple others. Salt has been used as money in the past. Cocoa beans, shells, and a kind of a common example that you'll see in prison movies. Maybe give you a second to think about that. What do prisoners often use as money in the movies? Cigarettes. So cigarettes, they have a value outside of money, but they're sometimes used as money. So they're used to exchange things and to price things, for example. Okay, so that's commodity money. That's a little bit outdated now. Most economies don't use that anymore. They use fiat money, or what we could think of as paper money. You pull out a dollar bill, ultimately it's just a piece of paper. The only reason why it has value is that, ultimately the government accepts it for taxes, right? So fiat money is money with no intrinsic value, but declared by the government as a country's legal tender. So money with no intrinsic value, but declared by the government I'm going to abbreviate government as the country's legal tender. Okay, and common examples there would be the US dollar, which I might in the future abbreviate as USD. It's a common abbreviation for the US dollar. Euros in the European Monetary Union, etc. But a lot of currencies all around the world. U.S. dollars. Yeah, there we go. So fiat money, it's just paper, but it has value and it functions as money because the government accepts it, basically. So most countries today use fiat money. All right, moving right along. Let's talk about the money supply. So basically here we're thinking about how much money is circulating, how much money is in the economy. And it's actually a trickier question than you might think, because it's not just cash. There's a lot of money. If you have money in your checking account, the bank probably just has that in there as some electronic line item that John Doe has $1,000 in the bank. If you go there, you can get it out as cash, but checking accounts, savings accounts, and then you move into different types of assets. All of these things, they can be converted to cash, but at different costs. Some things that actually cost money to transfer it back into cash. Sometimes it takes longer to convert it back into cash. And that whole idea is the idea of liquidity. So liquidity, the definition is the ease with which an asset can be converted to an economy's medium of exchange, which is cash. Let's write that down. The ease with which an asset can be converted to a country's medium of exchange. So basically, how easy is it to convert an asset to cash? The easier it is, the more liquid it is. The harder it is, the less liquid it is. And so we're going to do some examples here, but we're going to go from high levels of liquidity down to low levels of liquidity. So, the most liquid asset is cash because it is the country's medium of exchange. The most liquid asset. Okay, but then you move from there, and these are just examples, we'll talk about some more in a minute, but you've got something like stocks or bank accounts, cryptocurrencies, gold, sort of in the middle, right? Those assets, there's going to be a little bit of time, maybe a little cost involved in converting that money to cash, right? If you use an ATM that's not part of your bank, you may have a small ATM fee. So there's a small cost of converting a bank account balance into cash. And then you have other assets, much bigger, much less liquid assets, something like a house or a car or land. These are also assets. You can convert them into cash, but that's going to be, quite a process. It's going to take some time. It's going to take some resources to convert that into cash. So very low levels of liquidity for something like that. I mean, technically, even something like, a cow, right? A cow is an asset. You can convert it into cash. It just might take some time. Actually, it's probably ahead of land and a house because it's probably easier to sell a cow than a house. But in any case, this is the idea of liquidity. And coming back to this idea of the money supply, there are actually three main measurements of the money supply, M1, M2, and M3. And these measurements depend on liquidity. So again, M1 is going to start out at a very high level of liquidity, and M3 will be the lower level of liquidity among the three. And so if we're measuring how much money is moving around the economy, we can do it in different ways. So M1 is going to include, so this includes currency, just cash basically, what are called it's a fancy word for a checking account. They're called demand deposit accounts, DDA, demand deposit accounts, which I'm just going to write as checking account, right? Which is a very liquid thing, because if you have money in your checking account, it can be converted into cash very quickly by going to the bank, going to an ATM. So it's a very liquid asset. Then we've also got, which are a little uncommon now, but traveler's checks. Okay, so now as we move down to the M2 money supply to measure how much money is in the economy, M2 includes all of M1, so everything up above, plus SAVs, which is the kind of equivalent abbreviation of DDAs, but this is savings accounts. Sometimes they have more limits on withdrawing money from savings accounts than checking accounts. Money market, mutual funds, kind of just a place to store your money. Often, if you have any type of stock portfolio, but if your money's not in stocks but just waiting, kind of sitting there waiting to be invested, it's sitting in some other account, and these are often money market accounts. They're sometimes made up of very short-term U.S. Treasury bills. We're going to add that in a second. But basically, money that you can access very quickly. And then small time deposits, which here we're thinking about short-term CDs, certificates of deposit, for example, there, and something like Treasury bills. T-bill standing for Treasury bill. That's an asset issued by the federal government, which we'll talk about in a more detail later on. Okay, and then M3 includes all of M2, which by definition then would also include all of M1, plus large time deposits. So example here would be something like a 30-year government bond. Okay, it's not going to, so a treasury bond basically, which is just a longer term version of a treasury bill. And again, these are a treasury bond, a treasury bill. So this is the U.S. government, and when the U.S. government needs money, they issue a T-bill or a longer term T-bond out to the general public in exchange for money, right? And this might be like a 1-year bond. This might be a 30-year bond, and these are traded commonly in the financial markets. But getting rid of selling a 30-year bond is going to be harder to sell than a 1-year bond. So it's going to be a little bit less liquid. But you can just basically think of these as loans to the government. T-bills and T-bonds. Okay, there's our USA. Okay, all right. I think so. That's the money supply. We can measure it in these different ways, and when we do that, we're gonna have, you know, different amounts of money that we consider as circulating around in the country. Um, so what I'm going to do is I'm going to leave it off here, and in the next video we're going to pick it up and start talking about the Federal Reserve System. So a lot of these are going to have some similar ideas, so stick around for that and hope to see you in that video. Thanks.